Welcome, everyone, to the July 2026 edition of the Clear Vista Financial Perspectives. I'm Mark Trice, and I appreciate you joining us today and taking a little time for our update of the markets. It's also the 250th anniversary of our nation. So happy birthday, America. And but this one's going to be today. We're going to put a lot of data into the conversation. So we're going to go through a lot of charts. A lot of stuff's been going on. The Iran conflict is on, then it's off, then it's on again. So that's really affecting markets in somewhat. And we've really had a quite a volatile month in June, really a whole quarter if we go back and look at things with all the things that have been going on around the world. So let's jump right in. As always, you can send us your questions to our text line, 254-282-0495. That's for text only. And then also you can email us at info@clearvistafinancial.com. And we'll do our best to answer them in the program if we can. And then if not, within 24 hours, we'll get back to you with your answers to your questions and stuff. So as usual, we're going to do a little bit of market recap, dive deep into some economic data and go through several charts and then talk about what this means for you. And then finally, I think I might offer a perspective on our nation's birthday, 250th birthday. So let's jump right in. Have to give a little disclosure here. Take your time to review this. There will be a quiz at the end of the day's program. Just joking. Don't sweat it. All right, let's jump into our market recap. Well, it was generally a down month in the market indexes. So we had a lot of volatility going out through the month of June. We saw technology sell off quite a bit. In fact, last week we saw the NASDAQ go down by 4.5% in 1 week. It's since recovered a little bit of that here in the last few days of June, but still quite volatile. The S&P 500 ended the month down about 1%. And but year to date, the S&P is up about 9.5%. So still going in a positive year to date, certainly year over year growth pattern, and that's great. But the month of June was quite a volatile month. We usually don't see a lot of volatility in June historically. It's usually the end of July where we see volatility pick up. But with all the things that are going on around the world, it was to be expected that we would have a volatile month. The NASDAQ ended down minus 2.8%. As I said, technology was the driver, volatility in technology was the driver of that loss for the month. Year to date, I believe the NASDAQ is up double digits. I could refer to my cheat sheet here of little factoids if I could. Yeah, up 12.7 year to date through the month of June. So half the year gone. NASDAQ's up 12%. The Russell 2000 was the big surprise this month. The Russell 2000 has been doing very well this year. These are the small cap companies. The index ended the month up 3.5%, and year to date, the index is up just a little over 21%. So finally, after years of depressed appreciation in this index, we see the Russell 2000 setting new all-time highs. The S&P and the NASDAQ are still below their all-time highs, but not far away from those things. So long-term treasuries basically flat for the month. We'll get into bonds a little bit more here in a little bit, 0.77%. And year to date, the long-term treasury bond index is down 0.85%, so just a little less than 1%. And we'll look at composite bonds in just a moment. And then the moderate index, this is where a lot of clients kind of fall into in terms of risk tolerance. So we see that it was positive for the month, 1.26%. And for the year, the moderate index that we track is up 3%. So look at your portfolio if you think you're a moderate investor and see how you're doing. I think you'll be surprised, at least with our clients. let's jump on in because if I go the right way. I wanted to show this going back to 1990. This is the stock and bond annual returns over the years. Now, you see a lot of years are positive, but you have some negative years. Remember the early 2000s? Let's see, I can't point with this laser. The early 2000s, we had from 2000 through 2002 were negative years. Bonds, the U.S. bond index, aggregate index were positive for those years. That's the orange bars. The blue bars are the S&P 500. And of course, we all remember 2008 and early 2009. We have a big blue bar there. That was down quite a bit, 49% at the lowest point during that time. So year to date, the S&P, as I said, is up 9.5%. This is a little bit dated. It's 9.5% through the end of June. The U.S. aggregate Bloomberg bond index is flat for the year. So if you're holding a lot of bonds and you're thinking that you're being more conservative, you actually are going backwards or flat for the year. So be aware of that. And then I wanted to show this because you've got your annual returns and the pullbacks that we typically have every year, every year. And so you may have drawdowns in the market, but you don't necessarily end the year in the red. So I'm looking at many of these years. You can look and see the blue bar indicates what the return for the year for the S&P was. But then you look at the orange dots. These are the max drawdowns during the year. Now we can go back and look at a really volatile year like 2008, and you can see at one point the S&P was down 49%, only to be up 39 or 29% the following year, even with pullbacks during that time. Year to date, we're looking at our worst pullback for the S&P was minus 9%. That was near the end of March. And as I said, we're up close to 9.5, 10% return year to date. Still got a lot of time to go. Got 6 months more to go through the year, but we may have another pullback. Typically, we see 2 pullbacks or 3 pullbacks every year. So it's not uncommon to see these drawdowns like this. So let's go here. A lot of people focus on stock market price to earnings ratios. And right now, we're right around 20 times earnings is the stock price. And that seems to be fairly healthy. If you go back to the tech bubble when price to earnings ratios were close to 25 times, and we saw a big sell-off there. We saw a big increase back in the early 2020 when we had a big sell-off with COVID and the 2022 market. But we're still at healthy levels. The historical average for price to earnings ratios of stocks is around 16 times earnings. Okay, so we are above average, but that doesn't mean that it's an imminent problem, but it's something that you want to look at and make sure that the companies that you're investing in, that the stock price is not extremely high when we look at it from a price to earnings ratio, okay? So that's something we're still okay there. Okay, S&P 500 earnings per share. We have been below the long-term trend of this earnings per share. This is the trailing 12-month earnings per share. And you can see right now we're right around $301 or so earnings per share of the companies on the S&P. You can go back and look historically back in 2009 when we went through the big sell-off. Earnings per share fell quite a bit below the long-term trend. And then you had a growth cycle in the mid 2010s where earnings per share dropped quite a bit. And then you had an inflection point handle around that time, and we've had pretty much growth since then. So these are things we look at to see, well, is the market overheated? Is it cooling? What's going on? This is one of the indicators. And we're still kind of at long-term trends right now. And then I wanted to show this to put it in perspective because a lot of people, a number of people will get concerned when we have one pullback. And we've had many pullbacks over the years since the Great Depression. You can see some on this chart here. We look at the pandemic, and that seems like a little blip when you go back 100 years. The great financial crisis in '08 and '09, that certainly was a big time of a sell-off, but it recovered and it's up quite a bit since that time. Then you had the tech bubble. I'm going back from right to left. The tech bubble in 2000, that certainly was a long-term trend. But there's a lot of things, outside things and outside influences that were going on at the time as well. You had a little bit higher inflation. You had interest rates that were impacting the market. And so you can go back through time. And I remember there's Black Monday, October 1987. I had just bought my first stock in a local company that went public in my hometown. And then the market decides to go down 20% in one day. The stock market, the New York Stock Exchange, the NASDAQ, and other exchanges have put rules in place to prevent that from happening again. But that one day, the S&P was down over 20%, and then it ended up the year positive. So you can't really just look at one little pullback in time and be panicked. Investing you're in it for the long run. And we have to look at these things and these trends to know that, yes, we do have pullbacks. We do have recessions. We do have bear markets, but we don't have to worry about that over time. It just depends on the sequence of those returns are important when you're using your money for your goals, whether it be income and retirement or for one-time purchases and things. So we do have pullbacks, we do have recessions, we do have bear markets. Over time, we've had many. In fact, we've had 18 bear markets since the Great Depression, and yet the market is higher. Okay, this one may be a little bit harder to read here, but this is just I showed this last month, and it was updated, and these are looking at different historical events and where the S&P was 3 months, 6 months, and 12 months after. And right now, of course, we're in the Iran conflict. We're still working through that. Today, the peace agreement is on. Yesterday, it wasn't. So we just have to watch that over time. But you can see within most situations, most geopolitical events around the world, the market is higher a year later than after the event. You got the Israeli-Hamas strikes a few years ago. 9/11 and the invasion of Ukraine, those were two instances where the market was lower a year later. And a lot of that had to do with Ukraine, higher oil prices and things. And then with 9/11, there was a number of other outside economic factors that we were dealing with during that time. A little bit higher inflation. We were also dealing with some other geopolitical events that were going on during that time. So, but even then, and that was during basically the tech bubble burst of 2000 through 2002. I wouldn't put a whole lot of weight on the actual event causing the market to go down. And that's why we don't need to be too concerned or panicked when we have a geopolitical event. We have to let the market work its way through, and it usually does. Okay. I used to put up charts here that missing the worst days in the market would improve your performance, and that is true. But here's what missing the best days does to your portfolio. So you're missing out on potential returns here. I just show this to say, look, we're investing for the long haul. And then we like to look at, I love this performance quilt. We update it every month, but it basically is showing you the top market sectors and their production. Now, the red boxes are the S&P 500. We put that as the benchmark so you can kind of see how things are going. But we're looking at 2025. The top performing sector was emerging markets. And then, S&P was below that. We'll go back to 2018, And then you had the fixed income was the best performer. The worst performer during that time was emerging markets. So these change every year. This is why it's so important to have a diversified portfolio that covers all these sectors in some capacity, depending on your risk tolerance and your investment objectives, of course. But there's no ability to basically pick the winners in advance. We only have the benefit of hindsight in this situation, but it does tell us some stories that a lot of times different sectors perform differently year after year. Okay, the federal funds rate. The big news here was Kevin Warsh's first press meeting. We watched it in our office. He signaled a different approach, and really the big change is the Fed is going to get out of the business of trying to predict what the future Fed is going to do. And this is really refreshing to us because the markets react to that. And if we remove that absence of data or prediction, markets should behave normally. Now, the forecast for the future here, we have the Fed dot plots, and many of the Federal Reserve presidents predicted that actually interest rates would be a little higher toward the end of the year, but drop off after that. So currently we're in that 4.75 to 5%. Many of the Fed presidents continued their dot plots. Notably, Fed Chairman Kevin Warsh decided not to give his prediction. He's trying to change the culture. For too long, the Fed has been in the business of trying to predict, and the new chairman is saying, we're not trying to do that. We're going to respond to the data that we have. Still have the same two mandates. That's to keep inflation in check and to make sure that the employment is strong in the U.S. And they're going back to that. And so that is a big change. And you'll see more about that in the coming Federal Reserve Market Committee meetings in the future. We also had the passing today of Alan Greenspan. He was a great contributor to his leadership was a great contributor to the growth in the 90s. He didn't quite handle the big bust of things in 2000 and so forth, but he died at 100 years old. So we will miss him. He was a very, very smart and wise man that contributed to a lot to our economy over the years. We'll be looking at that. Federal Reserve balance sheet. See that big spike in 2020 when we just pumped tons of money and we kept pumping tons of money into the economy, and the result was high inflation. So the balance sheet is with the Federal Reserve is near historical norms now. We're right on that trend line, if you see. But the plan is to continue to reduce that Federal Reserve balance sheet. So when Chairman Warsh signaled this different leadership style, the Fed's going to have simpler communications. He did not offer a lot of information in the press release and its statement. The market reacted some when he was answering questions with the press, but that's to be expected anytime. The market's trying to predict, and the Fed chairman is now saying, "Hey, we're not going to try to predict, so quit asking." So it was kind of fun to watch. So we'll have to watch because inflation is creeping up just a little bit. Let me get through here and go and look at economic growth. They revised the U.S. GDP in the first quarter to 1% or 1.6%. We're going to have to go back and look at that again. I'm sure it'll get revised again. The Iranian conflict or invasion there was causing some issues with growth. But all in all, we'll talk here in a minute about the trade balance as well. So 1.6% growth in the first quarter. We should be getting new GDP here in the next couple of weeks. Unemployment rates. I bring up two things here. We've got the blue line is the actual unemployment. And so we're at 4.3% right now for unemployment across the country. And that was as of the end of May. That probably will improve. We're seeing new filings for unemployment insurance drop in each week in the month of June. So I would expect that might fall down. But the orange line is what I want to focus on here for just a minute. It's the underemployment. And underemployment in the US is at 8.1%, meaning that 8.1% of all Americans are underemployed. Perhaps they don't have a job that is a full-time job. Maybe they're working multiple part-time jobs and they're not quite able to, with those part-time jobs, get a total of 40 hours a week or more. So this is important. So we have that data going back to the 90s for underemployment when we started looking at that. And that was when we started seeing a little bit of a shift in the economy and how the workers work in the economy. We don't have the lifetime jobs anymore. A lot of people have part-time jobs or gigs that they do on the side. But hiring was broad-based in the month of May, and that's a positive sign for the stability of the economy. All right, so here's the CPI. As far as inflation, it ticked up last month to 4.2%. Core CPI, which takes out some of the more volatile things like oil and energy, was only at 2.9%. So yes, a little uptick in inflation. We expected that when oil prices started going up. Oil prices, as of this broadcast, are well below $70 a barrel. At one time, there were times where they're in the one teens or 120s during the Iran conflict. So oil has come back down. We should be seeing prices at the pump come down. I know here in Central Texas, I saw gas at the HEB yesterday at $3.03. So the gas prices are coming down. It may take the rest of the country a little bit longer to see those prices at the pump come down a little further. I'm not concerned about inflation right now. We're not seeing any type of long-term trend. We don't look at one data point and get concerned. We're going to look at the trend and we'll see what happens. Okay. More on the producer price index. Now, this is the cost to producers. It's related to the CPI, but in May, producer inflation was up 1.1%. Energy was up 10%. So, okay, there we go. That's that conversation about energy prices. Those are coming down, so we should see some improvement in the producer price index. The GDP, we talked about a little bit. There's a first quarter date. I didn't have that updated. 2.1% for the first quarter. We're seeing a lot of business investment, especially in artificial intelligence. Government spending's up a little bit, but investments in businesses through AI are still propping up the economy. I think I said last time that I had a stat from a Harvard study that basically said for 2025 that artificial intelligence investments and spending in the economy made up about 92% of all the growth in the economy last year. So AI is here. It's going to continue. We hope that it does well and continues to grow and helping grow our economy. Okay, interest rates. I said the Federal Reserve didn't raise or lower interest rates this last time, but here's the 10-year Treasury, which is really pegged. We see a lot of pegging to mortgage rates, car loan rates, etc. And that was in the mid fours for the month of June. We ended this last Friday, June 26th. And then the 2-year also has risen as well to a little over 4% as well. So what to watch that. We want to see that lower end of the yield curve be a little smaller. Let's look at this here. And we want to see it a little flatter. Now, this is yield curve in the last year. The blue line is the current rates, 4.9% versus a year ago. The 30-year Treasury was about 4.88%. So not a whole lot of change. We've had quite a bit of volatility in there, but not a whole lot of change over the last year when it comes to the 30-year Treasury. Some rising of the short-term rates and the 10-year bond. but well, let's continue to watch that. International trade, the trade deficit was slightly better than expected in the month of April. We don't have the May data just yet. The exports increased because we were putting a lot of oil out into the world economy. We do that. A lot of people think that we're there's the notion that's put out there that we're energy independent. Well, that's not exactly true because almost all the refineries that we have in the United States are designed to handle the heavier crude than is produced here in the U.S. So we're still importing a lot of oil for that, and we're exporting our oil, like the West Texas Intermediate crude and the oil and gas from different sites around the country. But that we exported a lot of that this time around, mainly because we do not have the refining capacity to handle the oil that we discover and are able to produce here in the U.S. Imports increased as well, led by computers, semiconductors, AI chips, all those different things. But this is positive for the economy. And we're going to continue to look at that, and we hope that continues to grow. Housing starts were down in May. I think I saw a stat for existing homes. Sales were down in June as well. And that's primarily because of interest rates and uncertainty about the economy. But construction overall started to slow a little bit. This generally is a predictive indicator. It just means that we're not seeing as much action in the markets. I know if you're trying to sell a house, it can take a lot longer now. But we're looking at housing starts here, and they are down quite a bit because we're going into a season where, with the immigration policy that's happening, we're not having a flood of people across the border illegally needing housing. So I would expect that to be the case, that housing starts, construction, all slowing because we're not having the incredible influx of immigration through across the border. So we don't need those houses as fast. So can see that slow down just a little bit. Existing home sales in May, they were up a little bit. We're seeing a little increase because rates came down. I think they were down a little bit in June. We'll have to see the final numbers whenever that comes up. I wanted to talk just a little bit here about Social Security because the annual report came out about the stability of Social Security, and it really didn't change. We still are looking at a situation where major changes will have to happen as early as 2032, and that's only 6 years away, folks. And Congress doesn't want to look at it. So they say that they're looking at different options, but no, this is going to be a political hot potato. Okay. George Bush, the junior, the second Bush, did try to address Social Security and fix it in his first term in office, and he almost didn't get a second term. Long-term solutions remain under discussion. I think there's a number of different things that they could do. For example, removing the income cap on which we're taxed on Social Security. But I want to say this, I think that they'll have to make some changes, and I think those changes are going to impact those that are far from retirement now. If you are taking your benefits, I don't think that's going to change much. This is just my personal opinion. There will be a lot of fighting and finger pointing in the next few years. So think about it now. The senators that are being elected, because we can have 1/3 of the senators elected every cycle. The senators that are elected or reelected this fall will be dealing with the Social Security changes and how to fix that. Like I said, there's a few things they can do. I think that we have to look at it if you are under the age of 60 or 55 or so. Social Security is not going to look like it does today when we get to that age. So, Ronald Reagan and Tip O'Neill came across the aisle to work to basically save Social Security and stretch it out another 40 years, but we've got to make some changes. This is not to mean that you should panic if you're on Social Security, but I think far too many people have counted Social Security as their fail-safe, large proportion of their retirement income, and you should not be thinking that. You need to make sure that you are saving for the future. Social Security still remains an important part of our retirement planning because it's income that we know is going to be there right now. But after 2032, that's when there is less money coming in than there is going out. Right now, there's still a trust fund, if you will, still there, but that's being drawn down very quickly. And so Congress will have to address this. I think there's a number of things they can do to help repair that. But of course, our nothing against our Congress, but most of them don't have a spine, and they're just really trying to get reelected to the next term. So, will we have some changes this fall in the midterm elections? Probably. Usually do of the first midterm election of a presidential cycle. That typically is the norm. I would expect that Democrats will pick up more seats in the House. I don't know how many. I don't know if it'll be enough to change the balance of power in the Congress, but those are all things that we'll be watching. But I do know is we should not be making choices with our investments and things based on what we think the political future might be. We have to deal with the facts that are here now, and we adapt to the changes as they happen. We do not try to predict the future, and this is one where none of us really know what's going to happen with that. But it is not something to get concerned about as of yet. Okay? So let's talk about how this all impacts your portfolio. We had a lot of data today. You want to make sure you're talking to your financial advisor. If you don't have one, we'd be happy to visit with you. And as I said before, don't panic. Stay focused on those long-term goals. Remember, go back to the historical chart of the S&P. Generally, the trend is up and to the right. There will be pullbacks. There will be bear markets. But generally, those trends are up and to the right. And if you are thinking that you want to invest in the markets, we've gotten a lot of calls lately for different companies. Don't invest for the short term or a quick hit. That's not investing. That's speculating. That's gambling. Make sure you're making decisions based on long-term goals, not the headlines or your political bias or whatever. Make sure you're staying informed. And as always, we want to plan ahead. We do have solutions for those of you that are still working and you're not working with an advisor. You've got a 401k at work. We have a lot of tools available to you if your plan has a self-directed brokerage option, and we'd be happy to discuss that with you. That's something that a lot of people ignore. And no, I hate to break the news to you, but your employer is not looking out for your 401k. They are just simply providing an option for you to invest. They are not watching the investments. They're not making changes for you. You need to take control of your 401k, and we can help you do that. Give us a call. Happy to discuss that with you. Okay, so we're halfway through the year. Financial statements will be going out from investment accounts. Check those statements. Talk to your financial advisor. Make sure you're educating yourself and being informed. An informed investor is the best type of investor, not an emotional investor. Emotional investors typically lose money. If you've got questions, you can text us 254-282-0495. We're getting to the end of the program. I'm not seeing questions on the board, which for these market updates, we usually don't see a lot of questions. We get questions afterwards. So if you have questions, send them in to us. You can always contact us via our 800 number, or if you would like to send us an email at info@clearvistafinancial.com. That's info@clearvistafinancial.com. You can always schedule an appointment with us, but we will get back to you to confirm that. And our next market update, will be August, the first Thursday in August at 10 o'clock as usual. Thanks, folks, and I hope you have a great month. Happy birthday to America. 250 years. That's quite an accomplishment. I know we have a lot of things that we're working on, but quite honestly, if we ever get to a point where we don't have things that we need to work on and improve in America, then we probably shouldn't be a country. So the future is bright. Opportunity is still great in America. People want to come here. And we want to say thank you to our founding fathers, to our God, our Lord Jesus Christ, for allowing that scenario to take place many, many years ago, 250 years ago. I would take the opportunity to read some articles on the founding fathers and the things that they struggled with during that time. It's quite fascinating. I know that I'm going today to go see a new movie on George Washington. I encourage you to check that out as well. Until next time, folks, you've been listening to Clear Vista Financial Perspectives, and we hope you have a great month, and happy birthday to America.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.